The power of the dividend snowball effect. Welcome to Wealth Echelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control of your wealth journey. The dividend snowball effect is a long-term investing strategy where reinvested dividends continuously generate more income over time. When you invest in dividend-paying stocks, you receive periodic payouts. Instead of spending these dividends, you reinvest them to buy more shares. As your share count grows, future dividends increase, allowing you to reinvest even more. This cycle accelerates over time, leading to exponential portfolio growth, much like a snowball rolling downhill, accumulating more snow as it goes. The longer you stay invested and reinvest your dividends, the greater your wealth accumulation becomes. The beauty of compounding. The beauty of compounding is that it doesn't require a massive initial investment to start. Even a small portfolio can grow significantly over time if you consistently reinvest your dividends. This growth can eventually turn into a reliable monthly income stream that keeps building with each reinvestment. So whether your goal is to earn an extra $1,000, $3,000, or even $5,000 in monthly income during retirement, the dividend snowball strategy could be your answer. But where do you start? Which stocks or ETFs should you consider to maximize your returns? To put this into perspective, if you reinvest your dividends, the growth potential is exponential. Over 20 to 30 years, the difference between reinvesting and simply taking the dividends as cash can be tens of thousands, even hundreds of thousands of dollars. This highlights the importance of letting your dividends work for you, fueling a snowball effect that builds lasting wealth. Where to invest for the dividend snowball effect? Building a dividend snowball starts with selecting the right investments, ones that not only provide stable dividend income, but also offer consistent growth. The key is to focus on companies with a strong history of dividend payments, financial stability, and the ability to sustain and grow their payouts over time. Here are some essential factors to consider when choosing where to invest. Dividend growth history. Look for companies that have consistently increased their dividends for at least 10 to 25 years. Companies with a strong track record of increasing dividends, often referred to as dividend aristocrats or dividend kings, demonstrate financial stability and commitment to returning value to shareholders. Dividend yield and payout ratio. A good dividend yield, typically between 2% and 6%, ensures a steady income stream, while a manageable payout ratio below 70% indicates that the company retains enough earnings to reinvest in growth. High payout ratios above 80% could be risky unless supported by strong cash flow. Financial stability and earnings growth. Investing in companies with strong revenue growth, solid earnings per share, EPS, and low debt levels ensures long-term dividend sustainability. Reviewing a company's profit margins, debt-to-equity ratio, and free cash flow can give you insight into its financial health. Industry and economic resilience. Some industries, such as consumer staples, utilities, healthcare, and telecommunications, tend to perform well even during economic downturns. Companies in these sectors often provide steady dividends, making them reliable choices for dividend investors. By carefully selecting and reinvesting in strong dividend-paying stocks or ETFs, you can maximize the benefits of the dividend snowball effect, allowing your wealth to grow exponentially over time. Altria Group Incorporated, MO, stands out in the tobacco industry with its iconic brands like Marlboro, Copenhagen, and Skoal. As of the latest data, Altria holds a market capitalization of approximately $85.21 billion, making it a formidable player in the market. The company's dividend yield is an attractive 8.32%, which is one of the highest among blue-chip stocks, signaling its commitment to returning value to shareholders. Financially, Altria demonstrates strong performance with an operating margin of 61.18% and a profit margin of 49.93%. This efficiency reflects in its earnings per share, EPS, of $5.9 and a relatively low price-to-earnings, PE ratio, of 8.61, indicating that the stock may be undervalued compared to its peers. Over the past year, Altria has delivered a total return of 31.5%, while its 3-year and 5-year returns stand at 32.3% and 61.36%, respectively. The company's 5-year compound annual growth rate, CAGR, is a notable 12.27%, underscoring its growth potential. The payout ratio for Altria is 85.13%, meaning that a substantial portion of its earnings is distributed as dividends to shareholders. This high payout ratio is typical for companies in mature industries like tobacco, where growth prospects are limited but cash flows are robust. Altria's focus on diversifying its product offerings, including investments in vapor products and cannabis, aims to mitigate declining cigarette volumes and position the company for future growth. If you were to invest $100,000 in Altria Group today and hold it for 20 years, assuming the compound annual growth rate of 12.27% continues, the investment would grow to approximately $1,540,000 with dividends reinvested. Over a 30-year period, the investment would balloon to around $2,731,000. This projection demonstrates the power of compounding and the potential for significant wealth accumulation with long-term investments in high-yield dividend stocks. The total dividend income over 20 years would amount to around $166,400, while over 30 years it would be approximately $428,820. This is particularly relevant as dividends are reinvested. The investment grows exponentially, providing increasingly larger returns over time. AT&T Incorporated, AT&T Inc., is a major player in the telecommunications industry, renowned for its extensive range of services, including wireless communications, data, broadband, and digital TV. With a current market capitalization of approximately $55.447 billion and a stock price of $21.66, AT&T remains a significant force in the market. The company's earnings per share, EPS, stand at $2.85, and it maintains a price-to-earnings, PE ratio, of 9.63, indicating that the stock may be undervalued compared to its peers. Over the past year, AT&T's stock has appreciated by 53.84%, outperforming the S&P 500's return of 37.72%. The company's compound annual growth rate, CAGR, over the past 20 years is 8.04%, highlighting its ability to generate steady long-term growth. Despite a revenue CAGR of negative 6.4% over the past 5 years, which points to some challenges in top-line growth, AT&T continues to invest heavily in its network infrastructure, with annual capital expenditures around $17 billion. AT&T's payout ratio is approximately 60%, reflecting a balanced approach to returning profits to shareholders while reinvesting in growth initiatives. The current dividend yield stands at 5.16%, with an annual dividend of $1.11 per share. Dividends per share have grown at a compound annual growth rate of 0.88% over the past 3 years, making AT&T an appealing choice for income-focused investors looking to live off dividends, as it consistently provides substantial returns. For an initial investment of $100,000 in AT&T, the growth after 20 years would be approximately $466,000, assuming the 20-year compound annual growth rate of 8.04%. After 30 years, the investment would grow to around $1 million, showcasing the power of compounding returns over time. This aligns well with the Dividend Snowball Effect, where reinvested dividends contribute to increasingly larger returns, exponentially growing the investment's value. The total dividend value over 20 years would be around $93,000, and over 30 years it would be approximately $279,000. The key to success: patience and consistency. Once you've built your dividend-focused portfolio, patience becomes your best ally. The dividend snowball effect doesn't happen overnight. It requires time to grow, much like planting a seed and waiting for it to become a tree. By reinvesting your dividends consistently, you'll see growth, even if it feels slow initially. Now that you've built your dividend-focused portfolio, remember patience is everything. The dividend snowball effect is a gradual process. Just like planting a seed, you won't see results overnight. But with each reinvested dividend payment, your portfolio strengthens. Even if the growth feels small at first, stick with it. And over time, you'll see the benefits. Every dividend reinvestment brings you closer to your goal of a steady monthly income that can eventually support your lifestyle or retirement. Start building your wealth today. This is the power of compounding in action, where small contributions lead to substantial wealth over the years. The sooner you start, the better the results. Even if your initial investment is modest, with consistency and discipline, the dividend snowball effect can grow into a reliable source of wealth that brings long-term security. Start your journey to financial freedom today. Invest in high-yield dividend stocks, reinvest your dividends, and watch the dividend snowball effect grow your wealth over time. Don't wait. Build a portfolio that works for you, providing stable income and long-term security. Subscribe for more strategies on smart investing. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At WealthEchelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.